Before we begin, it's critical to understand that this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this presentation is not, and should not be considered, financial or legal advice. You should consult with a qualified professional before making any decisions about your own insurance coverage. Your financial situation is unique, and the information here is not a substitute for personalized advice. You get into a minor car accident, that sickening crunch of metal, the jolt, the immediate pit in your stomach. But hey, that's why you pay hundreds of dollars every month for that full coverage auto insurance, right? You exchange information, you call your insurance company, confident you're protected. And that's when the real nightmare begins. The adjuster on the phone starts using words you've never heard before. Subrogation, tort, statutory limits. Suddenly, that full coverage you thought was an impenetrable shield has more holes than a block of Swiss cheese. You discover you're on the hook for $10,000, $20,000, maybe more. Your savings are wiped out. Your wages are garnished. All because of a 5-mile-per-hour fender bender in a parking lot. This isn't a scare tactic. This happens to thousands of Americans every single day. And the single biggest reason why is that the auto insurance industry is built on a foundation of confusion. It's designed to be complex. The language is intentionally dense, the options are overwhelming, and most of us just click accept on the cheapest quote we can find, praying we never have to use it. We spend more time researching which phone to buy than we do on the one contract that can either save our financial life or completely destroy it. Let me be blunt. Your auto insurance policy is one of the most important financial documents you will ever sign. Right up there with your mortgage. And for the next few minutes, we are going to pull back the curtain on this entire industry. We are going to demystify the jargon, expose the common traps, and give you a simple, powerful framework for building a policy that actually protects you. By the end of this, you won't just understand your insurance declaration page. You will be in command of it. You will know exactly what you're paying for, why you're paying for it, and how to spot a policy that's setting you up for failure. First, let's kill the biggest myth in the entire industry. The idea of full coverage. Write this down, tattoo it on your brain. There is no such thing as full coverage. It does not exist. It's a marketing term, a piece of slang that has tricked millions of people into a false sense of security. When people say full coverage, they usually mean a policy that includes 3 key components. Think of these as the 3 legs of a stool. If one is too short or missing entirely, the whole thing collapses. These 3 legs are liability, collision, and comprehensive. That's it. That's the core of almost every auto policy in America. And the most important one, the one that protects you from absolute financial ruin, is liability. Liability coverage has nothing to do with fixing your own car. Let me repeat that. Liability does not pay for your damages. It pays for the damages you cause to other people and their property. Think of it as your financial bodyguard. If you cause an accident, this is the part of your policy that steps in front of you and pays for the other person's medical bills, their lost wages, their pain and suffering, and the cost to repair or replace their vehicle. Without it, you are personally on the hook for every single penny of that. Your house, your savings, your future income. It's all at risk. Liability coverage is broken down into 2 parts: bodily injury and property damage. And on your policy, you'll see it written as a series of 3 numbers, like 25/50/25 or 100/300/100. This is the secret code that determines the strength of your financial bodyguard. And it is the single most misunderstood part of any policy. Let's break down what those numbers mean using a common state minimum. 25/50/25. The first number, 25, stands for $25,000. This is the maximum amount your insurance will pay for any single person's bodily injuries in an accident you cause. So, if you hit someone and their hospital bill is $40,000, your insurance pays the first $25,000. You get a bill for the remaining $15,000. The second number, 50, stands for $50,000. This is the maximum total amount your insurance will pay for all bodily injuries combined in a single accident. Let's say you swerve and hit a car with 3 people in it. Person A has $30,000 in injuries. Person B has $20,000. Person C has $10,000. That's a total of $60,000 in medical bills. Your policy will only pay out a total of $50,000. That leaves a $10,000 gap that you are legally responsible for. And notice, even though person A had $30,000 in bills, Your policy would only pay $25,000 toward their specific injuries because of that first number, the per-person limit. It's confusing, right? It's designed to be. The third number, 25, stands for $25,000. This is the maximum amount your insurance will pay for property damage you cause in an accident. This is for the other person's car, or if you hit a fence, a telephone pole, or the side of a building. Now, here is the terrifying part. Every state has a legal minimum amount of liability coverage you're required to have. And for many states, that minimum is a dangerously low number like 25/50/25. Following the state minimum is, without a doubt, one of the worst financial decisions a person can make. It is financial Russian roulette. Why? Because we don't live in a 25/50/25 world anymore. Think about the cars on the road today. The average price of a new car is nearly $50,000. A new Ford F-150 or a Chevy Silverado can easily top $70,000. A Tesla, BMW, and Audi? You're pushing six figures. If you have a $25,000 property damage limit and you so much as tap the bumper of a brand new Mercedes S-Class, you could total it. Your insurance pays $25,000, and the other driver's insurance company will then come after you, personally, for the remaining $75,000. They will sue you. They will get a judgment against you. They will garnish your wages for years. And that's just the car. What about the people? A single night in the emergency room can cost thousands of dollars. An ambulance ride, an MRI, a few stitches, you can blow past a $25,000 bodily injury limit before the person is even discharged from the hospital. If they need surgery, physical therapy, or can't work for a few months, you're looking at a six-figure lawsuit, and your state minimum policy will be a drop in the bucket. So what's the answer? You need to raise your limits. This is not about being a good person and taking care of the other driver. This is about pure, cold, rational self-preservation. This is about protecting your own assets. The difference in premium between a dangerously low state minimum policy and a genuinely protective policy is often surprisingly small. We're not talking about doubling your payment. Sometimes it's just the cost of a few cups of coffee a month to increase your coverage from $25,000 to $100,000. A good starting point for many people is 100/300/100. That means $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This single change moves you from the danger zone into a place of reasonable safety. It means you can cause a serious accident involving a brand new truck and multiple injuries without facing immediate financial ruin. For those with more assets to protect, a house, significant savings, investments, you'll want to consider even higher limits like $250/500/$250, and we'll talk about the ultimate layer of protection and umbrella policy later on. The key takeaway here is that liability insurance isn't for your car. It's for your life. It's the firewall that stands between a simple mistake on the road and losing everything you've ever worked for. So we've covered the absolute foundation, the coverage that protects you when you are at fault. But what about your car? What happens when a tree falls on it, or it gets stolen, or you're hit by someone who has no insurance at all? That's where the other two legs of the stool, collision and comprehensive, come into play. And understanding how they work together is the next step to becoming the master of your own policy. Let's think of collision and comprehensive as two different kinds of bodyguards for your car. They both have the same job, to protect your vehicle, but they specialize in different kinds of threats. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a streetlight, a guardrail, a fire hydrant, or even your own garage door if you misjudge the turn. The key word here is collision. Your car has to physically hit something. It also covers damage from rollovers. And here's the most important part. Collision coverage protects you regardless of who is at fault. If you cause the accident by rear-ending someone at a red light, your liability insurance pays for their car, and your collision coverage pays for your car. If someone else hits you and they have insurance, their liability coverage should pay for your car. But if they are uninsured or underinsured, a terrifyingly common problem, your own collision coverage can step in and save the day. It's your safety net for the chaos of the road. Now, let's talk about comprehensive. This is the bodyguard that protects your car from almost everything else. Think of it as non-collision coverage. It's for all the weird, random act of God stuff that can happen to a car when it's just sitting there minding its own business. A tree branch falls on it during a storm. A hailstorm turns your hood into a golf ball. Your car gets stolen from your driveway. Vandals decide to key it. You hit a deer on a dark country road. Fire, floods, riots, falling objects. All of this is covered by comprehensive. It's the coverage for life's unpredictable curveballs. The easiest way to remember the difference is this. Collision is for when your car hits something. Comprehensive is for when something happens to your car. So now our three-legged stool is complete. Liability protects other people's stuff. Collision protects your car from crashes. And comprehensive protects your car from the rest of the world. With these three, you have what's commonly known as full coverage. Now that term full coverage isn't an official insurance term. You won't find it on a policy. It's just shorthand people use, but it can be dangerously misleading. It makes it sound like you're covered for absolutely everything, which is never the case. But generally, when you hear it, it means a policy that includes liability, collision, and comprehensive. Now, here's where you get to start making strategic decisions. Both collision and comprehensive come with a critical component called a deductible. The deductible is the single most important number you need to understand to control the cost of your insurance. A deductible is simply the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. Think of it like a copay at the doctor's office. You pay your part first and then the insurance handles the rest. Let's say you have a $500 deductible for your collision coverage. One icy morning you slide into a pole, causing $4,000 worth of damage to your bumper and fender. You file a claim. You will pay the body shop the first $500. Your insurance company will then pay the remaining $3,500. If the damage was only $450, you wouldn't even file a claim because the cost of the repair is less than your deductible. You just pay for it yourself. Deductibles typically range from $250 all the way up to $2,000 or more. And this is where you have power. There is a direct, inverse relationship between your deductible and your premium. The amount you pay each month or every 6 months for your policy. The rule is simple. A higher deductible means a lower premium. A lower deductible means a higher premium. Why? Because with a higher deductible, you are agreeing to take on more of the financial risk yourself. You're telling the insurance company, don't worry about the small stuff. I can handle a $1,000 surprise expense. I only need you to step in for a real catastrophe. The insurance company loves this. It means they'll have to pay out on fewer small claims, which saves them a ton of money. So they reward you with a lower price for your policy. On the other hand, if you choose a low deductible, say $250, you're telling them, I can't afford a big unexpected bill. I need you to cover almost everything. This makes you a higher risk for them because they're more likely to have to pay out on a claim. To compensate for that higher risk, they charge you a higher premium. So which one should you choose? This is a deeply personal financial decision. It's a trade-off between saving money every month versus what you can afford to pay in an emergency. If you have a healthy emergency fund of a few $1,000s sitting in a savings account, you might feel comfortable choosing a $1,000 or even a $1,500 deductible. You'll save a significant amount on your premiums over the year. And if something does happen, you have the cash on hand to cover your part of the bill. You are essentially self-insuring for that first $1,000. But if you're living paycheck to paycheck and a sudden $1,000 expense would be financially devastating, you might be better off with a lower deductible like $500. Yes, you'll pay more each month, but you're buying peace of mind. You're paying a little extra to guarantee that you'll never be on the hook for more than $500 to get your car back on the road. There is no single right answer. It's about knowing your own financial stability and risk tolerance. Now, there's another crucial question to ask. Do you even need collision and comprehensive? Unlike liability insurance, no state legally requires you to have them. However, if you have a loan on your car or you're leasing it, the bank or finance company, who technically owns the car until you pay it off, will absolutely require you to have both. They need to protect their investment. If you crash the car and don't have coverage to fix it, they're the ones who lose out. But what if you own your car outright? What if it's an older car paid off for years? This is where you can potentially save a lot of money. You need to weigh the cost of the coverage against the value of your car. Insurance companies don't pay to replace your car with a brand new one. They pay you something called the actual cash value, or ACV. That's the value of your car the second before the accident happened, taking into account its age, mileage, and condition. In other words, it's depreciated value. Let's say you're driving a 15-year-old sedan that's worth about $3,000. You might be paying $500 a year just for your collision and comprehensive coverage. If you have a $1,000 deductible, The absolute most the insurance company would ever pay you in a total loss is $2,000. Is it worth paying $500 a year to protect a potential $2,000 payout? Maybe, but maybe not. At some point, the car's value drops so low that you're better off dropping these coverages, saving that premium money, and putting it in a new car fund instead. A good rule of thumb many people use is this. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, it might be time to consider dropping it. So you've built your three-legged stool. You've decided on your deductibles based on your personal finances. You've made a smart call on whether you even need collision and comp for your older car. You're feeling pretty good. You're protected if you hurt someone else, and you're protected if your car gets damaged or stolen. The stool is stable. But what about the person sitting on the stool? What about you? What happens if you're injured in an accident and have medical bills piling up? What if the other driver who hit you has no insurance, or not enough to cover your hospital stay? What if you can't work for 2 months while you recover? And on a more practical level, who pays for the rental car you need to get to work while your car is in the shop for 2 weeks? This is where your so-called full coverage policy reveals its gaps. And filling those gaps requires a whole new set of coverages that protect not just your car, but your health, your income, and your life. Let's start with the absolute bedrock of any auto insurance policy. The one part that is legally required in almost every state. It's called liability coverage. And here's the first critical mindset shift you need to make. Liability coverage isn't for you. It does absolutely nothing to fix your car or pay your medical bills. It's for everyone else. It's for the person you hit, the car you damage, the property you destroy. It's the coverage that stands between you and financial ruin when you make a mistake. Liability is split into two main parts: bodily injury and property damage. And when you look at your policy, you'll see them written as a series of 3 numbers, like 25/50/25 or 100/300/100. For years, most people just see those numbers, nod their head, and move on, having no idea that they are looking at the 3 most important numbers that will ever define their financial future. Let's break down what they actually mean using that accident we just imagined. The first 2 numbers are for bodily injury liability. Let's say your state minimum requirement is 25/50ths. The first number, 25, represents $25,000. That is the absolute maximum your insurance company will pay for a single person's injuries in an accident that you cause. The second number, 50, represents $50,000. That's the maximum total your policy will pay for injuries for the entire accident, no matter how many people are hurt. So you're at that intersection. You glance down at your phone for a split second, and you rear-end the car in front of you. It's a bad one. The driver of the other car is taken to the hospital. They have a broken leg that requires surgery, a week of hospital recovery, and months of physical therapy. They're a freelance graphic designer, and they can't work for 3 months. Let's add up the cost. The ambulance ride is $2,000. The emergency room visit is $5,000. The surgery to set their leg with plates and screws is $30,000. The hospital stay is another $15,000. We're already at $52,000 in medical bills, and we haven't even gotten to the months of follow-up appointments and physical therapy, or the lawsuit for their lost income and pain and suffering. Now look at your policy. You have the state minimum 25/50 coverage. Your insurance company writes a check for $25,000, the maximum for that one injured person, and then they wish you the best of luck. You are now personally on the hook for the remaining $27,000 in current medical bills, plus everything else that's coming. Their lawyer will send you a letter. And they won't be asking for the money. They will be telling you how you're going to pay it. They will sue you. They will get a judgment against you. And with that judgment, they can garnish your wages, taking money directly from your paycheck before you ever see it. They can put a lien on your house. They can seize the money in your bank accounts. Everything you've worked for, your savings, your future, can be wiped out because of one mistake in a policy that offered paper-thin protection. Now what if there were 2 people in that car? Your policy's second number, the 50, means your insurance will pay a maximum of $50,000 total. If one person's injuries are $40,000 and the others are $30,000, that's a total of $70,000. Your insurance pays out its max of $50,000, and you are personally on the hook for the other $20,000. State minimums are a financial trap. They provide the illusion of protection while leaving you catastrophically exposed. So what is the third number? That's your property damage liability. In our 25/50/25 example, That last 25 stands for $25,000. That's the maximum your policy will pay for any property you damage in an accident. And this isn't just the other person's car. This is anything you hit. A guardrail, a telephone pole, a fire hydrant, a storefront, a multi-car pileup. Let's go back to our accident. You didn't just hit any car. You hit a brand new electric SUV. The average price of a new car in the United States today is nearly $50,000. The car you hit is totaled. The frame is bent, the airbags deployed, and the complex battery pack is compromised. The insurance adjuster declares it a total loss. The value is $60,000. Your policy has $25,000 in property damage coverage. Your insurance company writes a check for $25,000 to the other driver's insurance company. And now their insurance company comes after you personally for the remaining $35,000. Again, your wages, your savings, your home, they are all at risk. All because you tried to save a few dollars a month on the one thing designed to protect you from this exact scenario. A $25,000 property damage limit in an era of $50,000 pickup trucks and $80,000 Teslas is like bringing a squirt gun to a forest fire. It's useless. So what are the right numbers? While I can't give you financial advice, I can tell you what many financial experts suggest as a responsible starting point. You'll often hear recommendations like 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This is a massive leap in protection from the state minimums. For people with significant assets to protect like a house, investments, or a high income, you'll often see recommendations of $250/500/100 or even higher. The logic is simple. Your liability coverage should be high enough to protect your net worth. If you have $200,000 in assets, having a policy that only covers $50,000 of bodily injury is a gamble you cannot afford to take. You're betting your entire financial life that you'll never cause a serious accident. And that is a terrible bet. Now you're probably thinking, this sounds expensive. Jumping from 25/50/25 to 100/300/100 must cost a fortune. And this is the most surprising part of all. It usually doesn't. The cost to increase your liability limits is often one of the cheapest and most valuable upgrades you can make to your policy. The difference between disastrously low coverage and excellent coverage might be as little as $10 or $20 a month. It is without a doubt the best money you will ever spend on insurance. You're not just buying coverage, you're buying peace of mind. You're building a financial fortress around your life. Think of it this way. The first dollar of coverage is the most expensive because it covers the most common, small accidents. But each additional dollar of coverage you buy gets progressively cheaper because the severe million-dollar accidents are much rarer. You're paying pennies for the dollars of coverage that can truly save you from bankruptcy. Before you ever think about deductibles or any other bells and whistles, maxing out your liability coverage to a level that protects your assets is the single most important decision you will make. So we've built the foundation. We've protected your life's work from a lawsuit if you're the one at fault. You're feeling more secure. But what happens if the roles are reversed? What if you're the one sitting at the red light, and someone plows into the back of you? It's clearly their fault. But as you're being loaded into the ambulance, you find out the driver who hit you has no insurance at all. Or worse, they have one of those laughably low state minimum policies we just talked about. Your medical bills are piling up, your car is destroyed, and the person responsible has no way to pay for it. Now what? This is where the insurance game gets personal. Because the answer to now what is brutally simple. You pay. You pay for everything. Your car, your hospital bills, your physical therapy, the wages you lose from being unable to work. It all comes out of your pocket. The person who caused all this, they might get a fine, maybe lose their license for a while. But you get the bills. It's a devastating financial trap that millions of people fall into, thinking their own full coverage insurance will save them. But it won't. Not unless you have two of the most important, most misunderstood, and most criminally underrated coverages on your entire policy. I'm talking about uninsured and underinsured motorist coverage. Let's call them UM and UIM for short. This is your financial bodyguard. It's the coverage that steps in and acts like the at-fault driver's insurance when they don't have any, or don't have enough. It protects you, your family, and anyone in your car from the financial irresponsibility of other drivers. And let me tell you, there is a lot of it out there. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That's like playing Russian roulette every time you merge onto the freeway. So let's break down exactly what this bodyguard does, because it comes in 2 distinct flavors: bodily injury and property damage. First, and by far the most important, is uninsured and underinsured motorist bodily injury coverage. UMBI and UIMBI. This is the one that protects your life and your livelihood. If an uninsured driver hits you and you end up in the hospital, this coverage pays for your medical expenses. Not just the emergency room visit, but the surgery, the follow-up appointments, the months of physical therapy. It also covers lost wages. If you're a contractor and you can't work for 6 months because of a back injury from the crash, this coverage can replace that lost income, keeping your family afloat. It can even cover things like pain and suffering, which is compensation for the non-financial toll the accident takes on your life. Think about our scenario from before. The driver with the state minimum $25,000 policy hits you. Your medical bills are $100,000. His insurance pays its max $25,000. You're left with a $75,000 hole. Where does that come from? Your health insurance might cover some of it, but you'll still have deductibles, copays, and out-of-network charges that can be crushing. But if you have underinsured motorist bodily injury coverage, your own policy steps in to cover that $75,000 gap, up to the limits you selected. You essentially sue your own insurance company to stand in the shoes of the guy who hit you. It's your safety net. It prevents a bad day on the road from turning into a life-altering financial catastrophe. The second flavor is uninsured motorist property damage, or UMPD. This one is more straightforward. It pays to repair or replace your car if it's damaged by an uninsured driver. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. This is where things get a little tricky, and it depends on your state. In some states, you can't even buy UMPD if you already have collision coverage, because it's considered redundant. In other states, they work together. For example, your UMPD might have a lower deductible than your collision coverage. So if an uninsured driver hits you, you can use your UMPD and pay, say, a $250 deductible instead of the $1,000 deductible on your collision policy. It can also cover the cost of a rental car while yours is in the shop. The key is to understand that collision coverage is for damage to your car, period. It doesn't care who was at fault. UMPD is specifically for when another identified driver is at fault and they are uninsured. It doesn't apply if you hit a tree, or if it's a hit and run where the driver is never found. So, when we talk about UM and UIM, we're really talking about a suite of coverages that protect you and your assets from the worst-case scenarios. And this brings us to a crucial decision you have to make when you buy it. How much do you need? The limits for UM/UIM are written just like your liability limits. A number for injuries per person, and a second number for total injuries per accident. So you might see it as 50/100 or 100/300. And here is one of the most important rules of thumb I can give you. You should never ever have lower UM/UIM limits than your own bodily injury liability limits. Think about what that means. If you have 100/300 in liability coverage, you're saying you want to provide up to $100,000 for a person you might injure. If you then choose only $25.50 for your own UM/UIM coverage, you are literally saying that a random stranger is worth 4 times more protection than you or your own child sitting in the passenger seat. It makes absolutely no sense. You are protecting strangers more than you are protecting your own family. The best practice is to mirror your limits. If you have $250/500 in liability, you should have $250/500 in UM/UIM. You are your most important asset. Your ability to earn an income is your family's most valuable resource. Protecting that asset should be your #1 priority. In many states, this coverage is surprisingly affordable, often a fraction of the cost of your liability coverage, because the insurance company knows they only have to pay out if the other driver is at fault. But we can go even deeper. For those of you with multiple cars on your policy, there's a powerful and often misunderstood option called stacking. This is a bit of an advanced move, but it can be a financial lifesaver. Imagine you have 2 cars on your policy, and you've chosen UM/UIM limits of 100/300. If you have a non-stacked policy, that 100/300 is your maximum payout, period. It doesn't matter how many cars you insure. But if you choose to stack your coverage, you can combine the limits for each car. So with 2 cars, your 100/300 coverage effectively becomes 200/600. With 3 cars, it becomes 300-900. You are multiplying your protection. This is absolutely massive in a catastrophic accident. Let's say you're hit by an uninsured drunk driver and suffer injuries that result in $350,000 in medical bills and lost wages. If you have a non-stacked 100/300 policy, your insurance will pay its max of $100,000. You're still on the hook for $250,000. But if you had that same policy stacked across 3 cars, your limit would be $300,000, covering almost the entire cost. Stacking costs a little more, and it's not available in every state. But if it's an option for you, you need to seriously consider it. It's one of the most cost-effective ways to buy yourself a huge amount of extra protection. It turns your standard policy into a fortress. So let's recap the mission here. You need to pull out your own insurance policy right now, find the declarations page and look for 2 lines: uninsured motorist bodily injury and underinsured motorist bodily injury. First, make sure you have them. In some states, it's optional and you might have signed a waiver rejecting it to save a few bucks a month, a decision that could cost you your house. Second, look at the limits. Are they the same as your liability limits? If not, you need to ask yourself why you value protecting a stranger more than protecting yourself. And third, find out if stacking is an option in your state and on your policy. Protecting yourself from the 1 in 8 drivers who have no insurance isn't being paranoid. It's being financially responsible. It's acknowledging the reality of the road and building a shield to protect your family from it. So now you're protected from the financial ghosts on the road. Your personal health and wealth are shielded from irresponsible drivers. But that's only half the equation. What about protecting the actual physical vehicle you drive every day? What about a hailstorm that turns your car into a golf ball? What if you back into a pole in a crowded parking lot? Or worse, what if you walk outside one morning and your car is just gone? That's where the other side of the coin comes in, and it's what most people think of when they say full coverage. So let's break down this idea of full coverage. The first thing you need to know is that full coverage isn't an actual type of insurance policy. You can't call your agent and say, "Give me the full coverage package." It's a slang term, a piece of industry jargon that's leaked into the mainstream. And what it almost always means is that a policy includes 2 specific, crucial types of coverage that protect your car: collision and comprehensive. These 2 are the yin and yang of protecting your own vehicle. They exist to fix or replace your car when bad things happen. Liability, which we covered before, is all about paying for damage you do to others. Collision and comprehensive are about you. They are selfish, and in the world of insurance, that's a very good thing. Let's start with collision coverage. The name is pretty self-explanatory. This covers damage to your car when you collide with something. That something could be another car, or it could be that concrete pole you backed into at the grocery store. The most important thing to understand about collision coverage is that it pays out regardless of who is at fault. This is a massive distinction. Let's say you're at a red light, and someone slams into you from behind. It's clearly their fault. In this case, their property damage liability coverage is what will pay to fix your car. But what if the roles are reversed? What if you're the one who glances down at your phone for 1 second too long and rear-ends the person in front of you? Your property damage liability will pay to fix their car. But what about yours? Without collision coverage, you are completely on your own. You'd be paying for every single cent of your repairs out of your own pocket. If your car is totaled, you get nothing. Collision coverage is your safety net for your own mistakes. It's the coverage that says, okay, you messed up, but we're not going to let it financially ruin you. It also covers you in situations where fault is tricky to determine, or in a hit and run where the at-fault driver is long gone. Now, when you use your collision coverage, there's a key concept you have to understand: the deductible. The deductible is the amount of money you have to pay out of pocket for a claim before your insurance company starts paying. Think of it as your share of the cost. You choose your deductible amount when you buy your policy. Common amounts are $500, $1,000, or even $2,500. Let's run through an example. Imagine you have a $1,000 collision deductible. You swerve to avoid a squirrel, lose control, and hit a guardrail. The body shop quotes you $8,000 to repair the damage. Because you have collision coverage, you file a claim. You will pay the first $1,000, your deductible, directly to the body shop. Your insurance company will then pay the remaining $7,000. If the damage was only $800, you wouldn't even file a claim because the entire cost is less than your deductible. You just pay it yourself. Choosing your deductible is a balancing act. A higher deductible means you're taking on more financial risk yourself, so the insurance company rewards you with a lower monthly or semi-annual premium. A lower deductible means the insurance company is on the hook for more money if you have a claim, so they charge you a higher premium. The golden rule for choosing a deductible is this: pick the highest amount you could comfortably pay tomorrow, in cash, without it causing a major financial crisis. If coming up with $1,000 would force you to sell things or go into debt, then a $1,000 deductible is too high for you. So that's collision. It covers damage from, well, collisions. But what about all the other horrible things that can happen to a car? What about that nightmare scenario where you walk out in the morning and your car is just gone? Stolen. That's not a collision. What if a huge hailstorm rolls through and your car looks like a golf ball? Not a collision. What if a tree branch falls on it during a storm? Or it catches fire? Or you hit a deer on a dark country road? None of these are collisions. And that's where the other half of full coverage comes in. Comprehensive coverage. Comprehensive is best thought of as the act of God and general bad luck coverage. It covers damage to your car from almost everything except a collision. It's the safety net for the unpredictable. Vandalism, theft, fire, flooding, hail, falling objects, hitting an animal. All of this falls under the comprehensive umbrella. Just like collision, comprehensive coverage has its own deductible, which works exactly the same way. You can choose to have the same deductible for both, like $500 for collision and $500 for comp, or you can have them be different. For example, since claims like cracked windshields are often covered under comprehensive, some people opt for a lower comprehensive deductible. Let's use the deer example. You're driving home late one night. A deer jumps out, and you can't avoid it. The impact causes $5,000 in damage to the front of your car. You have a $500 comprehensive deductible. You file a claim. You pay your $500, and the insurance company pays the other $4,500. Without comprehensive, you're on the hook for the full $5,000. So now we understand the two pillars of protecting your own vehicle: collision for accidents and comprehensive for everything else. This brings us to the million-dollar question. Do you actually need them? The answer depends on two things: your lender and your personal financial situation. First, your lender. If you have a loan or a lease on your car, the answer is almost certainly yes, you need them. In fact, your loan or lease agreement will explicitly require you to carry both collision and comprehensive coverage, usually with a maximum deductible amount, like $1,000. Why? Because until you pay it off, the bank or leasing company technically owns your car. It's their asset, and they are not going to let you drive their multi-thousand-dollar asset around without a guarantee that it can be repaired or replaced if something happens to it. If you have a loan or lease, you don't have a choice. But what if you own your car outright? What if you have the title free and clear? Now it's your decision, and it becomes a calculated financial risk. This is where you have to be brutally honest with yourself. The core question is, if your car were totaled tomorrow, could you afford to replace it without putting yourself in a financial bind? If your car is worth $30,000 and you don't have $30,000 sitting around, then dropping these coverages would be an incredibly risky gamble. But if your car is an old beater worth maybe $2,500, paying hundreds of dollars a year to insure it against damage might not make sense. A common rule of thumb people use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, you should seriously consider dropping it. Let's say your car is worth $4,000. You check your insurance statement and see that you're paying $500 per year specifically for the collision and comp portions of your policy. That's 12.5% of your car's total value. Think about it. In this scenario, the absolute maximum your insurance company would ever pay you is $4,000, and that's before they subtract your deductible. So if you have a $1,000 deductible, your maximum payout is only $3,000. Is it worth paying $500 a year to protect a potential $3,000 payout? Maybe not. You could instead take that $500 you're saving on premiums and put it into a dedicated car repair or replacement savings account. Over a few years, you've essentially self-insured yourself for the value of your older car. This is a deeply personal decision. It depends on the value of your car, the cost of your coverage, and your personal tolerance for risk. But understanding what collision and comprehensive are, how deductibles work, and when it might make sense to let them go, puts you in the driver's seat. You're no longer just blindly paying for full coverage. You're making an informed, strategic decision about how to best protect your assets. But protecting your car is only one piece of the puzzle. What about protecting yourself? What about your own medical bills if you're injured by a driver who has no insurance at all, or not enough to cover your hospital stay? That's a terrifyingly common scenario, and there are specific coverages designed to be your shield against it. This is where uninsured and underinsured motorist coverage comes in. It's not about protecting other people. It's about protecting you from the financial fallout caused by them. Think of it as an invisible shield you carry for yourself and your passengers. And trust me, you need it. Let's break it down because these two coverages, often bundled together, are arguably some of the most important dollars you will ever spend on insurance. First up is uninsured motorist coverage, or UM. The name says it all. This coverage kicks in when you are hit by a driver who has no insurance whatsoever. And before you think, oh, that's probably rare, let me hit you with a staggering statistic from the Insurance Research Council. About 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means on your average commute, you'll likely pass dozens, if not hundreds of cars driving illegally without a shred of liability coverage. Imagine this scenario. You're driving home, you have the green light, and someone blows through the red light, T-boning your car. It's a serious crash. You're injured, your car is a wreck, and the other driver, seeing the mess, panics and speeds off. It's a hit and run. You never get their information. Who pays for your medical bills? Who pays for your physical therapy? Who covers the wages you lose because you can't work for the next 6 weeks? Without uninsured motorist coverage, the answer is, you do. Your health insurance might cover some of the medical costs, but you'll still be on the hook for your deductible, your copays, and any treatments it doesn't cover. And it certainly won't give you a dime for the income you lost. But if you have uninsured motorist bodily injury coverage, or UMBI, your own insurance company steps in and acts as if it were the insurance company for the driver who fled. It covers your medical expenses, your pain and suffering, and your lost wages, up to the limits you selected. It's the hero you didn't know you needed, waiting in the wings. Now let's talk about its equally important twin, underinsured motorist coverage, or UIM. This is the one that catches so many smart, responsible people by surprise. UIM protects you when you're hit by a driver who has insurance, but they only have the bare minimum required by law. And the state minimums are terrifyingly low. In some states, the minimum bodily injury liability is just $15,000 per person. Let's go back to our crash scenario. This time, the driver who ran the red light doesn't flee. They pull over. They have insurance, they're apologetic, and you exchange information. You think you're in the clear, but your injuries are severe. You require surgery and a week-long hospital stay. The final bill comes in at $95,000. The at-fault driver's insurance company sends you a check for $15,000. That's it. That's their policy limit. They have fulfilled their legal obligation. You are now personally facing an $80,000 black hole of medical debt. Your life has been turned upside down by someone else's mistake, and now you're facing financial ruin because they chose to buy the cheapest policy possible. This is not a rare 1 in a million story. This happens every single day. This is precisely where underinsured motorist coverage saves you. If you had a UIM limit of, say, $100,000, your own insurance company would step in to cover the gap. It would pay the remaining $80,000 of your medical bills that the other driver's policy couldn't handle. It bridges the canyon between their pathetic coverage and your actual costs. Both UM and UIM are about controlling your own destiny. You can't control whether other people are responsible. You can't control if they buy insurance or how much they buy. But you can control whether their bad decision will destroy your financial future. When you buy these coverages, you're not betting against other drivers. You're betting on yourself. You are making the decision that your health, your family, and your financial stability are worth protecting regardless of who else is on the road. In many states, these coverages are mandatory, but even where they are optional, skipping them to save a few bucks a month is one of the biggest gambles a person can take. Okay, so UM and UIM are your defense against the irresponsibility of others. But what about covering medical costs in accidents where fault is complicated? Or even when it's your own? Or what if you just want your medical bills paid immediately without waiting weeks or months for insurance companies to argue over who's to blame? This brings us to 2 other crucial types of coverage for your own well-being. Medical payments coverage, often called MedPay, and personal injury protection, or PIP. Which one you can get often depends on the state you live in, specifically whether it's a no-fault state or not. Let's start with MedPay. It's the simpler of the two. MedPay is an optional coverage in most states that pays for medical and funeral expenses for you and your passengers after an accident, regardless of who is at fault. If you swerve to miss a deer and hit a guardrail, MedPay can cover your emergency room visit. If a friend is riding with you and is injured in a fender bender, it can cover their ambulance ride. The beauty of MedPay is its speed and simplicity. It pays out quickly, often before your health insurance, and it can be used to cover your health insurance deductible and co-pays. Think about it. If you have a $5,000 health insurance deductible, a $5,000 MedPay policy could mean you pay absolutely nothing out of pocket for your initial medical treatment after a crash. It's a fantastic financial buffer that fills the immediate gaps. It typically has lower coverage limits, maybe $1,000, $5,000, or $10,000, but it's an incredibly valuable tool for immediate peace of mind. Now let's talk about its bigger, more comprehensive cousin, personal injury protection, or PIP. If you live in a no-fault state like Florida, Michigan, or New York, to name a few, you'll be required to carry PIP. A no-fault system basically means that after an accident, your own auto insurance company pays for your initial medical expenses up to your PIP limit, no matter who caused the crash. The idea is to get you medical care and financial help quickly, without having to wait for a long, drawn-out legal battle to determine fault. But PIP goes way beyond what MedPay covers. This is a critical difference. While MedPay is strictly for medical and funeral expenses, PIP is a broad safety net that can also cover things like lost wages. If an injury from a car accident prevents you from working for 3 months, PIP can replace a percentage of your lost income, helping you keep the lights on and food on the table. It can also cover what's called replacement services. This means if your injuries prevent you from doing essential tasks like cleaning your house or taking care of your children, PIP can help pay for someone to perform those services for you. Let's make that real. Imagine you're a single parent and you break your leg in a car crash. You can't work, you can't drive your kids to school, you can't even manage basic chores. PIP doesn't just help pay the surgeon's bill. It helps replace your paycheck so you can pay rent. It helps pay for a service to drive your kids or help with childcare. It is a lifeline designed to keep your entire household functioning while you recover. So to recap the difference, MedPay is a smaller, optional coverage focused purely on paying medical bills quickly, regardless of fault. PIP is a broader, often mandatory coverage in no-fault states that covers medical bills, lost wages, and other essential services. It's a much more robust system of protection. The key takeaway here is that your policy isn't just about liability. A truly great insurance policy is a fortress. Liability is the outer wall, protecting you from claims from the outside. But uninsured and underinsured motorist coverage, along with MedPay or PIP, are the walls protecting the most important people inside that fortress: you and your family. So we've covered protecting other people and we've covered protecting your own body. But we haven't talked about the single biggest asset you're actually insuring: your car itself. What happens when your car is totaled in a crash, or stolen from your driveway, or crushed by a falling tree? That's where the two coverages that most people think of when they hear full coverage come into play, and understanding the subtle difference between them can save you thousands. Collision and comprehensive. These are the two pillars that hold up the idea of protecting your own vehicle. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it rolls over. The key here is that it covers your car regardless of who is at fault. Imagine you're navigating a ridiculously tight parking garage. You're trying to squeeze into a spot, you misjudge the turn, and you hear that soul-crushing sound: a deep metallic scrape as your passenger door meets a concrete pillar. It's 100% your fault. Your liability coverage, which we talked about before, will do absolutely nothing for you. It's designed to pay for damage you do to others. But your collision coverage? This is its moment to shine. It steps in to pay for the repair to your door, minus one very important little number: your deductible. The deductible is the cornerstone of how this coverage works. It's the amount of money you agree to pay out of pocket for a claim before the insurance company pays a single dollar. Think of it as your share of the risk. Deductibles typically range from $250 to $1,000, sometimes even more. Let's say the repair for that scraped door costs $2,000, and you have a $500 collision deductible. You pay the body shop the first $500, and your insurance company covers the remaining $1,500. Now, here's the trade-off, and this is where you start making strategic decisions. A higher deductible means you're taking on more personal risk, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is on the hook for more money, so they charge you a higher premium. Choosing a $1,000 deductible instead of a $500 one might save you $30 or $40 a month. That doesn't sound like much, but it's nearly $500 a year. The critical question you have to ask yourself is this: if I get into an accident tomorrow, can I comfortably write a check for $1,000 without it derailing my finances? If the answer is no, a higher deductible might be a dangerous gamble. If you have a healthy emergency fund, it could be a smart way to save money. So collision handles the crashes. But what about all the other forms of mayhem that can befall your car? What about the threats that have nothing to do with you being behind the wheel? That's where collision's partner, comprehensive coverage, comes in. Some insurance companies actually call it other than collision coverage, which is a perfect description. It covers damage to your car from a wild variety of events that are not a collision. This is the coverage for the chaos of the world. Think of it as the protector against acts of God and acts of people. This includes theft of your entire car. It includes vandalism, someone keying your paint or smashing a window. It covers fire, floods, hail that turns your hood into a dimpled piece of modern art, and falling objects like a tree branch in a windstorm. And here's a classic trivia question that trips up almost everyone. What happens when you hit a deer? You're driving, a deer leaps out, and you collide with it. Is that a collision claim? Logic says yes, but insurance rules say no. Hitting an animal is considered an other than collision event, so it falls under your comprehensive coverage. This little detail is huge because people often carry different deductibles for collision and comprehensive. Knowing which one applies can save you hundreds of dollars on the spot. Just like collision, comprehensive coverage has a deductible that you choose. And the same logic applies. A higher deductible equals a lower premium. You wake up one morning to find your driver's side window smashed and your stereo gone. The repair and replacement cost is $1,200. If you have a $250 comprehensive deductible, you pay $250, and insurance covers the other $950. So when you hear a car dealer or a friend talk about having full coverage, what they almost always mean is a policy that bundles liability, collision, and comprehensive together. But please burn this into your memory. Full coverage is a marketing term, not an insurance term. It does not, I repeat, does not mean you are covered for everything that could possibly happen. It's a powerful illusion. It gives you a false sense of security. Having full coverage won't pay for a rental car while yours is in the shop. It won't pay for your own medical bills if you're injured. And it won't pay to tow your car from the scene of an accident. Each of those scenarios requires separate, optional coverages that we still need to talk about. The real question is, do you actually need collision and comprehensive? For millions of drivers, the answer is simple because it's not their choice. If you have a loan on your car or you're leasing it, your lender or leasing company will almost certainly require you to carry both collision and comprehensive. And they'll probably dictate the maximum deductible you're allowed to have, usually $500 or $1,000. This makes perfect sense from their perspective. Until you pay it off, the bank technically owns the car. It's their asset, and they are going to make sure you have insurance to protect their investment from being wrecked, stolen, or flattened by a tree. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now the decision rests entirely on your shoulders. This is where you become your own risk manager. The decision boils down to one brutally honest question. If your car were totaled tomorrow in a crash or stolen from your driveway, could you afford to repair or replace it without causing a major financial crisis in your life? If your car is worth $30,000 and you don't have $30,000 sitting around to buy a new one, then paying for collision and comprehensive is non-negotiable. It's a vital shield for your most valuable asset. But what if you're driving a 15-year-old car that's worth maybe $3,000? This is where the math gets interesting. There's a great rule of thumb in the industry called the 10% rule. Here's how it works. Find out what your car is currently worth using a site like Kelley Blue Book. Then, look at your insurance statement and see how much you're paying specifically for the collision and comprehensive portions of your policy per year. If that annual cost is more than 10% of your car's value, it may be time to consider dropping them. Let's run the numbers. Your car is worth $3,000. Your collision and comprehensive coverages cost you $60 a month, which is $720 a year. That's 24% of your car's total value. In this scenario, you're paying a huge chunk of money for a policy that, in a worst-case scenario, will only pay out $3,000 minus your deductible. If you have a $500 deductible, the maximum payout is only $2,500. You might be better off canceling those coverages, saving that $720 a year, and putting it into a dedicated car replacement savings account. After 4 years, you'd have saved nearly $3,000, enough to replace the car on your own. However, there's a powerful counterargument: peace of mind. If coming up with $3,000 on short notice would be an absolute catastrophe for you and your family, then paying $720 a year for the guarantee that you're protected might be the smartest money you spend all year. It's a deeply personal decision that depends entirely on your car's value and your own financial stability. So you've protected other people and you've protected your car. You're all set, right? Not even close. Because we haven't talked about the single most financially devastating part of a car accident: your own body. What happens when your medical bills are $10, $50, or even $100,000? And what if the person who hit you is one of the millions of drivers with zero insurance? That's when you discover the two coverages that can literally save you from bankruptcy. These are uninsured and underinsured motorist coverages, and they are not optional if you want to be truly protected. Let's break it down because the distinction is critical. First, uninsured motorist coverage, or UM. This one is pretty straightforward. It protects you, your family, and anyone in your car if you're hit by a driver who has no insurance at all. A hit-and-run driver also falls into this category. Think about that for a second. Someone smashes into your car, sends you to the hospital, and then speeds off into the night, leaving you with the wreckage and the medical bills. Without uninsured motorist coverage, you're on your own. You'd have to sue a ghost. But with UM coverage, your own insurance company steps in and acts as if they were the insurance company for the person who hit you. They pay for your medical bills, your lost wages if you can't work, and even for your pain and suffering, up to the limits you selected. It's a safety net for the absolute worst-case scenario: being injured by someone who is both reckless and financially invisible. And don't think this is a rare occurrence. The Insurance Research Council estimates that about 1 in every 8 drivers on the road is uninsured. That's nearly 13% of the cars you see on your daily commute. In some states, it's as high as 1 in 4. Every time you get behind the wheel, you're rolling the dice, hoping the car next to you isn't part of that statistic. Having uninsured motorist coverage is how you take luck out of the equation. Now let's talk about its deceptive cousin: underinsured motorist coverage, or UIM. This one is, in my opinion, even more important because the situation is far more common and far more insidious. An underinsured driver is someone who has insurance, but they only carry the bare minimum liability limits required by the state. We talked about this before, those 25/50/25 policies. They are legally insured, but they are functionally useless in a serious accident. Let me paint you a picture. You're driving to work. Someone runs a red light and T-bones you. It's a bad one. You're rushed to the hospital. You need surgery, a multi-day hospital stay, physical therapy for months. Your medical bills quickly soar past $100,000. You can't work for the next 6 months, so you've lost $50,000 in income. Your total damages are $150,000, and it was clearly the other driver's fault. The good news? The other driver has insurance. You breathe a sigh of relief, but then you get the call. The driver who hit you only has the state minimum bodily injury liability of $25,000 per person. Their insurance company cuts you a check for $25,000 and that's it. They have fulfilled their legal obligation. You are still on the hook for the remaining $125,000. Your health insurance might cover some of the medical bills, but what about the copays, the deductibles, the lost wages? What about the permanent limp you now have? That $25,000 is a drop in the ocean. This is where underinsured motorist coverage becomes your financial superhero. It swoops in to cover the gap. If you had a UIM limit of $250,000, your own insurance company would pay the $125,000 difference between the other driver's pathetic limit and your actual damages. It saves you from financial ruin caused by someone else who decided to cheap out on their policy. Just like liability, UM and UIM coverages usually come in 2 parts: bodily injury and property damage. Uninsured motorist bodily injury, or UMBI, covers your medical bills. Underinsured motorist bodily injury, UIMBI, does the same for an underinsured driver. This is the part that protects your health and your wealth. Then there's uninsured motorist property damage, or UMPD. This covers repairs to your car if an uninsured driver hits you. Now you might be thinking, wait, doesn't collision coverage do that? And you're right, it does. If you have collision, it will pay to fix your car regardless of who is at fault, after you pay your deductible. So is UMPD redundant? Not necessarily. UMPD often has a much lower deductible than collision, sometimes as low as $100 or $250. So if an uninsured driver hits you, you could use your UMPD and pay a much smaller amount out of pocket to get your car fixed. In some states, you can't even buy UMPD if you already have collision, so you'll need to check your local rules. But if you have the option, a low-deductible UMPD can be a nice little perk. So, the million-dollar question, how much UM and UIM coverage should you get? The answer is simple and non-negotiable. You should have UM/UIM limits that are at least equal to the bodily injury liability limits you chose for yourself. Think about the logic here. If you decided that you need $250,000 per person and $500,000 per accident to protect your assets from someone you might injure, why on earth would you give yourself and your family less protection? Are you and your passengers worth less than a stranger you might hit? Of course not. You're choosing your liability limits based on your net worth and your potential to be sued. You should choose your UM/UIM limits based on the value of your own health, your ability to earn an income, and the well-being of your family. Matching them is the absolute baseline for responsible self-protection. The cost to increase these limits is often shockingly small for the immense peace of mind it provides. But there's one more secret weapon when it comes to UM/UIM coverage that most people have never even heard of. It's called stacking. And in the states that allow it, it's like unlocking a superpower for your insurance policy. Here's how it works. Let's say you have 2 cars on your policy. On each car, you have UM/UIM coverage with limits of $100,000 per person. If you choose an unstacked policy, which is usually the default and slightly cheaper option, your limit is just that, $100,000. It doesn't matter how many cars you have. But if you pay a little extra for a stacked policy, you can literally stack the coverages from each car on top of each other. So with those 2 cars, your $100,000 limit instantly becomes a $200,000 limit. If you have 3 cars, it becomes a $300,000 limit. This stacked limit applies to you whether you're driving any of your cars, riding as a passenger in a friend's car, or even if you're a pedestrian or a cyclist who gets hit by an uninsured driver. It is one of the most powerful and cost-effective ways to massively increase your protection. The premium difference between a stacked and unstacked policy is often trivial. Maybe a few dollars a month, but it can double or triple your coverage when you need it most. Not all states offer stacking, but if yours does, you need to seriously consider it. You have to specifically ask for it. Don't assume you have it. Call your agent and say the magic words. Do I have a stacked or unstacked uninsured motorist policy? The answer could be worth hundreds of thousands of dollars. So UM and UIM are your shield against the financial irresponsibility of other drivers. They ensure that your recovery from an accident is determined by your doctors, not by the shockingly low policy limits of the person who hit you. But this raises another crucial question. UM and UIM kick in after fault is determined and after the other driver's insurance, or lack thereof, is sorted out. What about the immediate aftermath? Who pays for the ambulance ride from the scene of the accident? Who covers that initial emergency room visit before the lawyers and adjusters even get involved? There's another, faster layer of medical protection designed to pay right away, regardless of who was at fault, and it can be a lifesaver even in a minor fender bender. This immediate coverage is called medical payments coverage, or MedPay for short. And in some states it has a superpowered sibling called personal injury protection, or PIP. Think of them as your personal on-call paramedics of insurance. They don't care who was at fault. They don't wait for a police report to be finalized. Their only job is to pay for your and your passengers' medical expenses right away so you can focus on getting better. Let's start with MedPay. It's the simpler of the two and is available in most states. MedPay covers reasonable and necessary medical and funeral expenses for you and anyone in your car who gets injured in an accident. It doesn't matter if you hit a deer, got rear-ended, or were the one who made a mistake. It covers ambulance rides, doctor visits, x-rays, dental work if you chipped a tooth on the steering wheel, you name it. So why would you need this if you have health insurance? That is the million-dollar question, and the answer is surprisingly simple. First, deductibles. Let's say you have a great health insurance plan, but it comes with a $2,000 deductible you have to pay out of pocket before your insurance starts covering anything. You get into a minor fender bender, your neck is sore, and you go to the ER for a checkup. That visit, with a CT scan, could easily cost more than your deductible. Instead of paying that $2,000 from your savings, your MedPay coverage, which might have a limit of $5,000 or $10,000, can pay it for you. Fills the gap. Second, your passengers. Your health insurance covers you. It doesn't cover your friend who was riding shotgun. If they get hurt, they'd have to use their own health insurance or sue the at-fault driver. But with MedPay on your auto policy, their initial medical bills can be covered, right then and there. It's an incredible piece of goodwill that can prevent a friendship from getting complicated by medical bills and legal issues. MedPay is typically very inexpensive to add to a policy, often just a few dollars a month, and for that price, it provides incredible peace of mind and immediate financial first aid. Now let's talk about its bigger, more powerful sibling, personal injury protection or PIP. If you live in what's called a no-fault state, like Florida, Michigan, or New York, among others, you're likely required to carry PIP. In a no-fault system, your own insurance company pays for your initial injuries up to a certain limit, regardless of who caused the accident. This is designed to speed up payments and keep smaller claims out of the court system. And PIP is where this concept gets truly life-changing, because it doesn't just cover medical bills. PIP is designed to make you whole again after an accident, and it understands that your injuries are more than just doctor's bills. The single most powerful benefit of PIP is that it can cover lost wages. Imagine you're a freelance contractor, a gig worker, or you just don't have paid sick leave. You get into an accident that's not your fault and you break your wrist. You can't work for 6 weeks. The other driver's liability insurance might eventually pay for your lost income, but that could take months, even years of fighting and negotiation. How do you pay your rent next month? PIP is the answer. It can pay out a percentage of your lost income, typically up to a certain limit, while you're recovering. It's a financial bridge that keeps your life from falling apart, while the bigger insurance battle plays out. But it doesn't stop there. PIP can also cover what are called essential services. If your injury prevents you from taking care of your kids, it could help pay for childcare. If you can't clean your house, it could help pay for a cleaning service. It covers rehabilitation costs and other necessary expenses you incur because of your injury. It is a profoundly more comprehensive safety net than MedPay. So, if you're in a state where PIP is an option, you need to look at it very, very closely. It protects not just your body, but your entire livelihood. Now, we've spent all this time building a fortress of coverage for ourselves. Liability to protect our assets from others, collision and comp to fix our own car, and MedPay or PIP to cover our own bodies. But this entire system is built on one very fragile assumption, that if someone else hits you and hurts you, they actually have insurance to pay for it. What happens when that assumption is wrong? What happens when the person who runs a red light and T-bones your car, sending you to the hospital, gets out and says, "I'm so sorry, I don't have insurance"? Or, almost as bad, they have the absolute bare minimum coverage required by law. A policy so small it wouldn't even cover the cost of your totaled minivan, let alone your reconstructive surgery. Suddenly, you're the victim, but you're facing financial ruin. The at-fault system has failed you completely. This isn't some rare freak occurrence. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means in any crowded intersection, there are likely dozens of cars driving around with no coverage at all. This is where the two most underrated, most critical, and most frequently misunderstood coverages come into play: uninsured motorist and underinsured motorist protection. Let's call them UM and UIM. You absolutely need to understand what these do, because they are the only things that stand between you and a driver with nothing to lose. Let's start with uninsured motorist, or UM. Think of UM coverage as a ghost policy. When you are hit by a driver who has no insurance, your UM coverage magically steps in and pretends to be the insurance that driver should have had. It pays for your injuries, your pain and suffering, and your lost wages, all the things their bodily injury liability was supposed to cover. In some states, there's also a version called uninsured motorist property damage, or UMPD, which, as the name implies, pays to repair or replace your car. So, in that nightmare scenario where the uninsured driver totals your car, your UM coverage can pay for your medical bills beyond what your MedPay or PIP covers, and your UMPD or your own collision coverage can pay for your car. You are essentially insuring yourself against the irresponsibility of others. Now let's talk about the more common and insidious threat: the underinsured motorist, or UIM. This is the driver who followed the law but just barely. Let's say your state's minimum liability requirement is $25,000 for bodily injury. The driver who hits you has this minimum policy, but your accident was serious. You needed surgery, weeks of physical therapy, and you were out of work. Your total medical bills and lost wages come to $100,000. The at-fault driver's insurance company will write you a check for their policy limit, $25,000. And that's it. That's all they are legally obligated to pay. You are still $75,000 in the hole. You could sue the driver personally for the rest, but if they're driving with minimum coverage, odds are they don't have $75,000 in a bank account waiting for you. This is where underinsured motorist, or UIM coverage becomes your hero. Once the other driver's policy is exhausted, you can file a claim against your own UIM policy to cover the difference. So if you had a UIM limit of $100,000, it would step in and pay that remaining $75,000 gap. Here's the crucial takeaway. The limits you choose for your UM and UIM coverage should, ideally, mirror the limits you chose for your own bodily injury liability. If you decided that you need $250,000 of liability coverage to protect your own assets from a lawsuit, doesn't it make sense that you would want that exact same amount of coverage to protect yourself and your family if you're hit by someone with no insurance at all? You are just as valuable as the person you might hit. Protect yourself accordingly. So now the main structure is built. We have our liability shield, our car repair tools with collision and comp, and our personal safety net with MedPay, PIP, UM, and UIM. This is the core of a truly protective policy. But we're not quite done. Around the edges of this core policy are a handful of smaller, optional coverages. They're like the special features on a new car. You might not need all of them, but a few can make your life dramatically easier in a crisis for just pennies on the dollar. And in our final part, we're going to explore this secret menu of insurance, and then put it all together to show you how to shop like a pro, and get the absolute best deal on the perfect policy for you. First up on this secret menu is rental reimbursement. Think about it. Your car is in the shop for 2 weeks after an accident. How do you get to work? To school? To the grocery store? Without this coverage, you're either begging for rides or paying $50, $60, even $100 a day out of pocket for a rental car. That adds up faster than a speeding ticket. But with rental reimbursement, for literally the cost of a fancy coffee each month, your insurance company will cover that rental. It's a small price for maintaining your freedom and sanity when your life is already disrupted. Next, let's talk about roadside assistance. Yes, you might have a separate service for this, but adding it to your auto policy is often dirt cheap and incredibly convenient. A flat tire on a dark highway, a dead battery in a freezing parking lot, running out of gas miles from anywhere. These aren't just inconveniences. They can be genuinely scary situations. For a few extra dollars per year, you get a 24/7 hotline that dispatches a tow truck, a locksmith, or someone with a gas can directly to your location. It's like having a guardian angel for your car, always on call. Now for a big one, especially if you have a loan or lease on your car. GAP insurance. GAP stands for Guaranteed Asset Protection, and it's a financial lifesaver. Here's the terrifying reality. The second you drive a new car off the lot, it depreciates. It loses value. If you get into a major accident a year later and your car is totaled, your insurance company will pay you what the car is worth at that moment, its market value. But you might still owe the bank way more than that on your loan. That difference, that gap, could be thousands of dollars that you are legally on the hook for. You'd be making payments on a car that doesn't even exist anymore. GAP insurance pays off that difference, ensuring you don't owe a single penny on a pile of scrap metal. If you have a car loan, you need to seriously ask yourself if you can afford not to have this. And for those of you who bought a brand new car, there's an even better option: new car replacement coverage. This is the VIP version of GAP insurance. If your new car is totaled within the first year or two, instead of just giving you the depreciated value, the insurance company will pay to replace it with a brand new car of the same make and model. It erases that initial depreciation hit completely. It's a premium feature for sure, but it turns a total catastrophe into a total do-over. These are the tools the pros use. They're not always necessary for everyone, but knowing they exist allows you to tailor your policy from a generic, off-the-rack suit into a perfectly bespoke shield of armor. Okay, you've made it. You understand liability, you know the difference between collision and comprehensive, you've mastered deductibles, and now you even know the secret menu. It's time to put it all together. This is the final mission: to go out into the marketplace and secure the absolute best policy for the best price. Here is your step-by-step battle plan. Step 1. Gather your intelligence. Before you even think about getting a quote, collect all your necessary documents. You'll need your current insurance policy's declaration page. That's the summary of your current coverages. You'll need the vehicle identification number, or VIN, for every car you want to insure. You'll need the driver's license numbers for every driver in your household. And you'll need an honest estimate of the miles you drive each year. Having this all in front of you makes the process 10 times faster and more accurate. Step 2. Define your mission parameters. This is where you decide on your coverage levels. Look back at what we've learned. What are your state's minimum liability requirements? Now, what do you actually need to protect your assets? Are you going for a 100/300/100 liability limit, or maybe more? Look at your car's value. Is it worth carrying collision and comprehensive? If so, what deductible can you comfortably afford to pay out of pocket? A $500 deductible? $1,000? Decide on these numbers before you shop. This is your ideal policy blueprint. Step 3. Shop across enemy lines. Do not just get one quote. That's the biggest mistake people make. You need to get quotes from at least 3 different types of insurance providers. First, get a quote from a major direct writer like a Geico or a Progressive, the ones you see on TV all the time. Second, get a quote from a captive agent, like someone from State Farm or Allstate, who only sells their company's products. And third, and this is the pro move, contact an independent insurance agent or broker. These agents work with dozens of different companies, and their job is to shop the market for you to find the best fit. This 3-pronged approach ensures you see a huge swath of the market and don't miss out on a hidden gem. Step 4. Execute the quote process with precision. Whether you're online or on the phone, use the blueprint you created in Step 2. Enter the exact same liability limits, the exact same deductibles, and the exact same optional coverages for every single quote. This is critical. You have to compare apples to apples. A quote that's $200 cheaper might look great, until you realize it has half the liability coverage and a massive deductible. Be consistent, be meticulous, and be honest. Don't lie about speeding tickets or accidents. They will find out, and it can lead to your policy being canceled or a claim being denied right when you need it most. Step 5. Analyze the results. Lay your quotes out side by side. Your first look will be at the price, the premium. But don't stop there. Double-check that every single coverage and limit is identical. Look at the secret menu items. Does one quote include rental reimbursement while another doesn't? Are the payment plan options different? Some companies charge extra fees for paying monthly. Don't just compare the price. Compare the promise. Step 6. The discount offensive. Once you have your top 2 or 3 contenders, it's time to pick up the phone. Call them. Tell them you have a competing offer and ask, "Is this the absolute best price you can give me?" Then start hunting for discounts. Ask them directly, "What discounts am I eligible for?" You'd be shocked what's available. There are discounts for being a good student, for taking a defensive driving course, for bundling your auto and home insurance, for driving a low number of miles, for having anti-theft devices, for being a member of certain alumni associations or professional groups. There are even discounts for having certain jobs like being a teacher or an engineer. You have to ask. They won't always volunteer this information. This single phone call can save you hundreds of dollars. Step 7, and this is the final check, read the contract. Nobody likes doing it, but you're about to sign a legally binding contract. The company will send you the policy documents. At least read the summary. What is specifically excluded? Are there any weird clauses? If you use your car for a side hustle like delivering pizzas or for a rideshare service, is that covered? You need to know before there's a problem. Finally, Step 8, make your choice. The cheapest policy is not always the best policy. You're buying 2 things: a financial product and a service. How good is that company's service? Look up their claim satisfaction ratings from places like J.D. Power or Consumer Reports. A company that's $10 cheaper per month isn't a bargain if they fight you tooth and nail when you have a legitimate claim. You're choosing a partner who will be there for you on one of the worst days of your life. Choose wisely. And that's it. You've done it. You've gone from a novice, likely overpaying for a policy you didn't understand, to an expert shopper capable of navigating this complex world with confidence. You now know how to build a policy that doesn't just meet the legal minimum, but that creates a fortress around your financial life. This isn't just about saving a few $100 a year, though that's a fantastic bonus. It's about peace of mind. It's about knowing that if that moment of chaos ever arrives, the screech of tires, the crunch of metal, that you made the right choices. That your family, your savings, and your future are protected. You've invested the time to understand this, and that knowledge is now a permanent asset. Use it every time your policy comes up for renewal. Keep shopping, keep comparing, and keep yourself protected. Your future self will thank you for it.